That was a 700,000 job decline from January. So in January, we had 10.6 million. That dropped to 9.9. So the jobs available, job openings contracted by 700,000 jobs. Now, this is important because this is one of the data points that the Fed is looking at, because less jobs mean tighter economy, which means inflation coming down. So everything is geared towards inflation coming down. So this is a positive sign when it comes to inflation getting under control and the Fed accomplishing their goals. So this shows the labor market's cooling down. For now, for every unemployed person, there's 1.7 jobs available, and that's for February. In January, for every unemployed person, there were 1.9 jobs available. So that has dropped. And again, this is something the Fed is looking at very closely. Immediately after this jobs data came out, mortgage rates dropped. So mortgage rates are now in the mid to low 6% range. I'm personally quoting some customers with, really good credit, good down payment. I'm quoting them rates under 6%. Okay, so this has been a while since rates have been under 6%. So why did this happen? Why did mortgage rates drop immediately after the jobs data? Well, again, very simple. Just like most markets, like stocks, the mortgage market, the mortgage rates are forward looking. So that means rates are based on what we think the Fed's fund rate or what mortgage rates will be in 6 months. So what this means is the mortgage market expects inflation to come down, and they're betting on the Fed cutting rates in the future because inflation will be coming down. So they're betting rates will come down. Now, even though the Fed has come out and they've said we're not cutting rates in 2023, the market feels a little bit differently. So rates have come down. That's good news. How is this affecting the housing market? Well, the number one thing I want you to know when you're watching this video is the inventory in the United States is very tight. So again, it depends on your town, on your city, on your region, where you are in the country. Everywhere is going to be a little bit different, but there's a lot of YouTubers and a lot of people out there still calling for a housing crash. And the reason that this is not going to happen is because simple supply and demand economics, there's nothing else to say about it other than inventory is too low. There is just not enough supply, and there's still a decent amount of demand. So let's take a quick look at a chart here that's going to explain how little inventory we actually have. So this is a chart of the housing inventory according to the National Association of Realtors. As we can see, as of February 2023, there are only 980,000 homes available on the market in all of the United States. As we go back to 2022, you see there was a little time period where there were less homes on the market during COVID, the tail end of COVID. But as you could see, these numbers have been coming down year over year over year. If we just go back to 2016, 2017, or 2018, we had over 1.8 and 2 million homes on the market. That's double, more than double what we have now. If we go back to 2014, 2015, we had over almost 2.4 million homes for sale. 2.5 times what we have available right now. So very simple supply and demand economics. There's the reason there will not be a crash is because of this and this alone. So again, it depends where in the country you are, but chances are there's not going to be a housing crash. Very simple, no matter what rates are, and rates are coming down. Okay, rates are on the way down. So let's move forward. How is this going to affect the housing market? Okay, so again, home values are holding steady. I think in some areas, Home values have come down about 10%. I think the average since the peak is 10% drop in home values. Nothing too crazy. After the run up that we had of 20% year, 2 years in a row after COVID, a 10% correction, I welcome that. Totally normal. It's good and healthy for the market to have a little bit of a correction. Just like any other market, you don't want anything to go up in a straight line because then it will crash. So we've had a slight decline in home values, nothing too crazy, but what's going to happen moving forward? That's the key question. The reason, in my opinion, we don't have a lot of homes on the market is because most homeowners have locked in their interest rate at 3%. So there's probably many of you millennials, Gen X, boomers watching this video, you've locked in an interest rate of 3%. So even if you desire to move, if you're an empty nester or you want to upgrade because you have a growing family, the chances are you're not going to trade your 3% interest rate to sell your home and move and lock in a 6.5% interest rate. So you're not going to sell. You're going to hold off because the difference in your mortgage payment is just going to be too drastic. So let's take a quick example. If you have a $500,000 mortgage right now and you locked in a 3% a couple of years ago or a year ago, you're paying about $2,100. If you were to sell, now you have to buy a home at a higher price than what you paid for your previous home. So that's number one. And number two, if you got the same $500,000 mortgage at 6.5%, your payment would be $3,100. So you'd be paying $1,000 more a month to sell and get the same amount of mortgage on a new house. Now, if we take $1 million example, that payment increase from 3% to 6.5%, now you're paying $2,000 more every single month to have the same exact mortgage amount. That is what's stopping a lot of people from putting their house on the market and selling, and that's why inventory is staying low. Now, what I expect is towards the end of the year, rates are going to start coming down. As I just said, we're hovering around the 6% range. When we're hovering around 5%, or maybe if you have really good credit, you can get a rate under 5%. You could get something in the 4% range. That's going to be a little bit more incentive for people to sell and trade their 3% mortgage and go to something like a 4.5 or 4.75 because the jump is not going to be that drastic. Yes, it'll be a little bit higher, but you'll bite the bullet. My family's growing. I'll go ahead and list the house, sell, and trade my 3% mortgage for a 4.5. Or again, if you're an empty nester, same thing. I'll trade my 3% for a 4.5 because it's a little bit of a jump, but nothing too crazy. And right now, going from a 3 to 6.5%, most homeowners just don't want to do it. And that's why inventory is staying low. Now, when rates come down, you might see more homes on the market because people are willing to trade in that interest rate. So we might see a little bit, again, I don't see home values coming down. If rates come down, that's only going to push home values up higher, but it's going to create more inventory because people are going to be willing to list, sell, trade their 3% mortgage. So again, if you found value, please like and subscribe, and I'll see you guys on the next video.